Okay, well, Abhilash Narayan is now joining us, Senior Investment Strategist, Group Wealth Management at Standard Chartered. Abhilash, good to have you with us here. Thanks very much for your time. Are things looking better, or at the margin, the risk-reward starting to look a little unfavorable with the very sharp rally we've had here? And for those who are already in, Abhilash, what's the advice? Stay put, or do you think at the margin maybe start to look to take some profits?
Well, I think the outlook that we have from a macroeconomic perspective is quite mixed, right? So on one hand, people are concerned that there could be a global recession in US, but on the other hand, there's a growing sort of camp which says that US will avoid a recession, and this is termed as a no landing camp. Now, from our perspective, we think that investors should keep calm and carry on. So, what we mean by that is, yes, there is possibility of a further equity market upside, but it makes sense to take advantage of the opportunities in the market which are out there. So, be it high quality government bonds, high quality corporate bonds, but also within equity sectors and remain diversified. Because given the uncertainty, maybe having a diversified exposure has a better probability of delivering positive returns as compared to taking more concentrated bets.
Abhilash, which camp are you in? Is US going to see a recession, or it's going to be a no recession, no landing, a kind of an economy?
Well, our base case is that US will see a recession. So we are assigning around a 70% probability of recession. But we've pushed back the date towards 2024 because if we look at it, US economic data has been quite resilient. We'll get the non-farm payrolls data later this week, but by and large, the job market remains quite strong. The services sector, which is about 75% of US economy, that's quite strong, and that's one of the reasons why markets are concerned that the Fed may hike rates maybe by one more time. But we think that the impact on the markets is going to be muted because a large part of that has already been priced in.
Hi, Abhilash. Morning. Do you think we can get more than one rate hike from the Fed? I mean, going by the data points, as you said, recession is just being pushed back, and the data points that are coming out are looking very, very good. And any idea in terms of y'all, what kind of view y'all have on a Fed rate cut? Is that out of the window for the next year or so?
Well, to answer the Fed rate cut question, we think it's unlikely that the Fed will cut rates this year. But going into Q1 2024, we think that the Fed will have to start cutting rates as the economic slowdown will intensify. Because, if you look at US economic data, it is quite divergent. The manufacturing sector has been in contraction for many, many months on the trot. If you look at some of the other indicators, especially in the housing sector, we are seeing signs of softness there. And even in the job market, while the headline data remains strong, temporary worker hiring, which is usually an early indicator of job market strength, has started to sort of weaken. So, in the near term, yes, the Fed should hike rates or could hike rate by 25 basis points. But ultimately, US inflation is expected to be around 4% in the upcoming data print. Fed rates are at 5.25% already. So the room for Fed to hike rates by a large degree is sort of limited in our perspective.
What about India then? I think for the global equities, for the global markets, you said keep calm and carry on. Well, here we're not just carrying on, we're galloping, we're scaling record highs every single day. What's the advice for Indian investors and for fresh money into India now?
Yeah, so we think that obviously Indian equities have been supported by the strong GDP growth, by robust earnings expectations, and the fact that foreign investors have been putting in more money. But looking ahead, we think that Indian equities should broadly perform in line with Asian equities, because from a valuation perspective, the PE ratio for Indian equities is trading at around 60% premium to rest of Asia. Now, within India, where we see better opportunities is in a few sectoral plays, but also, if you think about it from a size perspective, we think that the mid-cap and small-cap equities are looking increasingly attractive to us because of two reasons. One, the earnings revisions that we've seen in the past few months have been quite robust. If you look at mid-cap equities, we are looking for we have looked at double-digit earnings revision in the past few months. And the second thing is we think that RBI is done with the rate hikes, and we expect 10-year government bond yields to come down slightly. So that at the margin should again be supportive for mid-cap and small-cap equities.
All right, Abhilash, we'll leave it there. Good speaking with you as always. Thanks very much for that chat.
Thank you.
Well, we'll take a quick commercial break here. We are back and our list of top stocks to watch for the day. Lots of sort of pre-Q1 quarterly updates coming up, especially financials reporting a fair bit, and other stocks with news flow as well. Stay with us.